Hello and welcome to Options in Plain English Advanced Edition. Today we're going to be talking about pin risk. Pin risk is a risk that every option trader should know about, but especially option sellers who like to either take their options to expiration and maybe let them expire worthless, or who exclusively trade options on expiration day. When we talk about pin risk, we're talking about the uncertainty that option sellers have regarding exercise and assignment on expiration day for stock settled options. So if you're talking about cash settled options, this risk doesn't exist. Also, for any day other than expiration day, this doesn't exist. And also, if the underlying price is not very close to the strike price, if it's deep in the money or deep out of the money, this risk also doesn't exist. So it's a very particular risk, but it's an important risk because it can lead to huge losses. Now let's take a look at option sellers and option buyers, but we're going to focus first on the sellers because those are the ones that are exposed to pin risk. If you're talking about an option seller, one of the things, if the underlying price on expiration day is very close to strike price, so you are at risk of your option being in the money and then out of the money and then back in the money, so it's close to the at the money price, then one of the things that you can do and very easily remove this risk is just close your position. Of course, if you were hoping for those options to expire worthless, then you're not going to get to keep the whole premium because you're going to have to buy it for a certain price. Now, when you compare this to pin risk, you have to evaluate whether this is worth keeping the position and hoping for it to expire worthless. If you're a seller and you decide not to close your positions, you have to be aware of the fact that the buyer controls the exercise and assignment process. So all you can do once you decide that you're not going to close your position, you're gonna wait and hope for it to expire out of the money so that it's worthless. It expires worthless, and you get to keep all the credit that you got initially when you put the position on. Then all you can do is wait because you don't control that process anymore. The option buyers, when the underlying price is very close to the strike price, there's basically two different processes that control the exercise and assignment process. One of them is exercise by exception, which means that this is called automatic exercise, where if an option expires in the money even by 1 cent, then your broker is going to exercise your position automatically so that you don't leave some money on the table. So if it's in the money even by 1 cent, then you're going to get your exercise, and the seller or some seller is going to be assigned. Now, this has also a little wrinkle here because there is something called a do not exercise order or request, which means that if I am the option buyer, so I'm the option holder, and I have an option, but even though it is going to expire in the money, if it expires in the money by 1 cent or 2 cents or 3 cents, it might not be in my best interest to exercise because maybe I don't have the funds to carry the position that would result from the exercise process. Then I could put in a do not exercise request, in which case my broker, even though the option expires in the money, it is not going to be exercised. So even exercise by exception, which seems to be a cut and dry rule, is not so straightforward because the buyer could also have a do not exercise request. And the second one is a manual exercise request. So when would this apply? Well, if it expires out of the money and for some reason you want to exercise, then you can put in a manual exercise request. If it expires at the money or in any other situation. Now here the wrinkle is very interesting. The buyer has, depending on the broker, but most brokers have up to 90 minutes after the close on expiration day to request manual exercise of their positions. So option buyers, not the sellers, the buyers have the right or the opportunity to exercise manually, which means by putting in a request up to 90 minutes after the close on expiration day. Now, some brokers might have this window for 60 minutes to give themselves time to process those requests, or maybe 45 minutes. But most brokers honor this this window by some time. So there is a certain window of time after the close where you can manually request exercising or the exercise of your positions. Okay, so now the buyers now this process is not so straightforward anymore, because you can request exercise of your positions after hours, and after hours those options are not tradable anymore. So the option sellers, if the underlying price is very slightly in the money, or and when comparing it to a strike price, the sellers are in a situation where there's nothing they can do about it. The only thing that they could do is potentially hedge with stock. So with the underlying, that's the only thing that they could do. That's the only action that they could take. So in this case, the sellers are said to be pinned to the position because there's nothing they can do. The price is very close to the strike price, and anything could happen. So there's three potential outcomes of this exercise or of this situation. Those would be nothing. So maybe even though it expired very slightly in the money, or it expired at the money or out of the money, the buyer decides not to do anything. So you don't get assigned. Everything expires worthless, and then you get to keep the whole credit. So that's the best outcome, of course, for an option seller. Number two, you get partially assigned. So let's say, for example, you were short 5 put options. So 5 contracts, 5 put contracts. So let's say you get assigned on 2. So after those options expire, instead of having nothing if it expires worthless, or a full assignment on those positions, so instead of having 500 shares, maybe you can have 200 shares. So there's no way for you to know beforehand because you don't control that process. So the seller is at the expense of the buyer. So the buyer, you can be partially assigned, you could be not assigned at all, or you can be fully assigned if you have your options, your short options, and then there is an assignment for a full assignment for that position. And remember that those are on a first come first serve basis. So there is a bit of a lottery process to assign those exercise requests. So your broker might be assigned, and then your broker itself has to assign those positions to all the different account holders. So now, in summary, what you have is the option seller decides not to close their positions. They expire either out of the money or at the money or very close. Then the buyer could potentially manually exercise up to 90 minutes after the close, or if it's in the money by 1 cent at 4 p.m. Eastern time, which is the official closing price, then you might be assigned or not. You don't have any control over it. That's why this is a risk, because there's nothing you can control about it if you're a seller. Okay. Now, as a seller, you could be not assigned at all, partially assigned, or fully assigned. And what does this mean? Well, maybe you thought that you didn't have any exposure because your options expired out of the money, your short options. So you think that your account is flat, and then you get exercised either partially or fully. And what's going to happen is, if you have, let's say, for example, the usual situation is that the options expire on Friday. So you're here on the Friday, and then it's going to be the weekend, and then Monday morning. So at this point, you don't know if you're going to be assigned because you don't control that process, and the price makes it unclear whether there's going to be an exercise or not. At that point, you might be taking on some risk that you were not aware of. And by doing that, you're going to be exposed Monday morning. Why? Because let's say, for example, you had 5 contracts, 5 put contracts that you were short, and then you get assigned on 200 shares. And then let's say over the weekend, there's some bad news about the company, and those shares, those 2 options that were assigned turn into 200 shares that you are long now. And then if the price collapses, you come in Monday morning with 200 shares, and because their price went down, you're going to have a loss that you were not even aware that could happen to you. This is what's called pin risk. Now let's take a look at an example. And this situation has happened to many traders, and they're surprised that it happened to them. So we're going to go through it, and we're going to understand what happened behind the scenes, okay? So this is a price chart of an underlying. This in this particular case, I'm looking at Apple, but it could be any underlying, okay? So this is stock settled. This is expiration day, okay? Expiration Friday. And this is 1 day's worth of data. So what we're looking at here is this is the normal trading hours, and this is the extended hours. So this is after hours in gray. Now, every candlestick is 5 minutes of data. Okay, so this is expiration. This is the close right here. Okay, and in this situation, we're gonna analyze a put seller who is short the expiring 311 put. So this dotted line here, this little dash line here, or dotted, represents the $311 price. Okay, so the put seller is short the expiring 311 put, and of course there is a buyer who is long the expiring 311 put. So these are the counterparts. Okay, so the stock is trading. You have the 311. It's again, we're talking about stock settled because Apple is a stock that is stock settled, not cash settled. This is expiration Friday, and the underlying price is very close to the strike price. So these are the 3 conditions for a potential pinning situation, or for a potential pin risk. Okay, so the price is moving, is changing, and it reaches 311. So it's around 311, but it closes at 311 and a half, something like that. $311.20, something like that. So exercise by exception doesn't trigger because it takes the price at 4:01:30. So 90 seconds after the close, that's the price that gets reported as the closing price. So in this case, the put seller looks at this position and says, okay, so it expired out of the money because at the money is 311. This is like 311.20. So I'm good. I'm safe. But something's going to happen after hours now. So remember, the buyer has 90 minutes after the close to exercise. So it has this window to potentially exercise his long put. So even though the seller's hands are tied here. Okay, so the seller cannot. So if it was possible for him to say, okay, now this is getting dangerous, I'm going to close it. Well, you can't close it anymore. Right at 4 o'clock Eastern time, the options stop trading and you can't do anything anymore. What you could do is hedge with stock. So if you're nervous or worried about your position, you could go to the after hours market and hedge with stock. Now in that case, the problem for the put seller is that he or she doesn't know if you're going to be assigned or not. So now we're going to continue. We're going to analyze what's going to happen. So the price starts going down after hours. So look here. This is the price, okay? Starts going down after hours. Remember, we're in the window where the put buyer can exercise. And by the way, these times are Central Time. So it's you have to add 1 hour to get the Eastern Standard Times. So you look at the price going down after hours, and what's going to happen is, okay, the put buyer says, oh, okay, you know what I'm going to do now that the price is under my put strike price. What I can do is I can buy the stock after hours, knowing that I'm hedged at 311. So what's going to happen is, let's say for example here, the put buyer buys at 310. Now he is safe because he knows that he's got an ace up his sleeve where he could exercise at 311 no matter what. So he can sell at 311. So from 310 to 311, he knows that he's going to make $1 at least. But what if the stock price starts shooting up and then the stock price, maybe there's some announcement after hours and maybe the stock goes to 320, then you're gonna get huge profits and with no risk, because you can always be selling the stock that you got. You can always sell it at 311, so there is no risk for you. Okay, so this is a perfectly hedged position. The put buyer now buys the stock, and knowing that he's got a put that he can exercise to sell at this price, so there's no risk for him. Okay, now again, for example, here in this little candlestick, it went up to above 311. So if over the whole after hour session the price started going higher and higher, then of course the buyer is not going to exercise. He's going to actually sell it at the price in the market, of course. And this 311 is actually going to expire worthless. He's not going to use it because now he had more profit by selling in the market. So in that case, that's one option. So that's situation number one. Nothing happens. Okay. But now if we analyze what actually happened, is the price continued to go down, down, down. And at some point here, when the window is coming to an end, right, the put buyer decides, okay, I'm not going to make money. So I should have lost the money from here, from 310 to 309, let's say. But because I have my put, I can always sell at 311. So the put buyer decides to exercise his put. So at 311. So now he's going to be buying at 310 and selling at 311. He made a cool dollar. So that's the action that's a refined trader knows this, and knows that he can go in the after hour session, and if he's got a put that is about to expire worthless, now he knows that he's hedged with it. So remember, the seller is not participating at all here. Okay, so there is no input from him or her. Okay, so the put buyer decides to exercise his put. And what's going to happen? The put seller is going to get the stock assigned to him at 311. Now remember, the put seller, the last thing that he knew, and if you don't know about pin risk, that's all you're going to know, is that it expired out of the money. But he's going to be assigned regardless. So this is the situation where you're now going to have stock assigned to you over the weekend. Now you're going to have risk that you didn't know that you had. And on Monday morning, you're going to come in and you're going to be long the stock, in this case, Apple. And what if Apple's trading at 250 by the time you come in Monday morning? You're going to have a huge loss from 311 to 250. So $61 of loss that you were not aware that you had, because in your mind, your 311 put expired worthless. Yes, it did, but after hours you got assigned because the buyer decided to exercise. So this is a risk that you didn't know you had if you didn't know about pin risk. Now you can say, okay, so now I'm aware of this and now I know that I can do this. What am I going to do? Okay, so let's go back to before all of this action happened. At 4 o'clock, you decide that you're not going to close your position. Okay, you're going to roll the dice. So as a seller, what could you do? Okay, so you can say, fine, if I'm assigned I'm going to be assigned long stock, what I can do is I can short 100 shares of Apple so that when I get assigned, they cancel each other out so that I'm flat. Yeah, but what if you don't get assigned? Because you don't know that. Once 4 o'clock happens, anything after, you have no control. You're pinned. Your position is pinned. Okay? So now your potential short stock position is going to be a risk just as well as if you didn't do anything, because now your risk is that you're not going to get assigned, and then you're going to have a short position. And what happens if by the time you roll in Monday morning, the Apple is trading at 3:30? So now you're going to be short at 3:11, and you're going to be absorbing the loss from 3:11 to 3:30. Okay, so you don't know. The main information that you should get from this lesson is that as a seller, there is no way for you to know. So there is nothing you can do to hedge this uncertainty, because it doesn't depend on you, and it depends on unknown risks and unquantifiable risks, because you could be assigned your whole position, you could be assigned a portion of your position. How do you know what to do? Actually, for example, you could be here looking at the after hours action and knowing that you're going to get assigned. And then what you're going to say is, okay, you know what? I am going to be assigned. If you are aware, if you're a sophisticated trader now because you know about pin risk, what I'm going to do is I'm going to sell stock short here. Okay. So to protect myself. So yeah, you're going to protect yourself from here and anything below, but you're going to be locking in a loss between 311 and whatever price you decide to put your hedge on at. Okay, so that's better than being completely exposed, but still you're going to be locking in a loss. So for the seller, for the option seller, if you are very close to expiration, say 5 minutes before expiration, and your price is around the strike price that you have and on a position that you're short, then you're extremely at risk of this situation happening to you and you not knowing how to hedge. You don't know whether you should buy stock, short stock, what your position is going to be over the weekend. And the important thing is that you're going to be exposed to a position that you might not know you have. So by the time you come in Monday morning, maybe you are long 100 shares and the price collapsed. So now you're looking at losses that you didn't even know you had. Okay. So this is pin risk. Okay. So now that you know about it, so what's the solution? How do we fix this? Well, it might seem logical and intuitive, but we're still going to mention that. You can use cash settle instruments, such as, for example, indices. In that case, you just go and take the closing price here, the settlement price, and then if you made money, you're gonna receive cash. If you lost money, you're gonna pay cash out, but you're never going to be assigned any position. So that gets rid of the pin risk problem. The second solution is always close your positions. And remember, we're talking about the sellers here. The buyers are not in this situation. The buyers don't have pin risk. In fact, the buyers have a bit of an advantage here because they can exercise after hours for up to 90 minutes after the close. And also another thing I'd like to mention is that it doesn't matter whether you have as a seller, if you have a short option whose underlying price or whose strike price is around the underlying price on expiration day with very little time to go until expiration, then you're at risk. It doesn't matter whether it's a naked position, so whether you're short a naked put or a naked call, or whether it's part of a spread, or whether it's part of another more complex position. As long as you have a leg or an option that you're short on expiration day, with the price very close to a strike price and with very little time to go, you are going to be at risk. And this is going to be pin risk, which is what we saw here in this lesson. So I hope that this was informational for you and that now you have all the tools to, if you're a seller, avoid this unnecessary risk And if you're a buyer, so that you know more about how this process works and what you can do when your options expire very close to at the money, but out of the money, and if there's some action after hours. Thank you very much for your attention, and goodbye.